Good evening. Welcome to Vantage Point, the first of its kind investment talk show in Sri Lanka. I believe we are meeting almost after 1 month's break, as we could not have the program, as we mentioned to you earlier, on 23rd June, which was a religious holiday. And we at Vantage Point are very particular about the appropriateness of everything we do, and we always try to deliver the best to our viewers. Now, I'm Mashani Wijetunga, and joining with me on today's program is our key resource personnel, Mr. Chamikra Gunawardena, founder of Investor Eye Private Limited, the pioneering bilingual independent investment research firm in Sri Lanka. Now, we also have a very special guest attending our program today. He's none other than Dr. Nandalal Veerasinghe, the Deputy Governor of Central Bank of Sri Lanka, who is also a chief economist in Sri Lanka, a well-known, prominent economist in Sri Lanka. Now, recapping our last week's program, we actually gave a brief introduction about Vantage Point, and we also discussed the importance of this program. Now, if you do remember, we mentioned, in fact, Mr. Gunawardena, our resource personnel, mentioned the importance of macroeconomy in capital markets performance of a country. Now, starting on that note, I would like to actually direct my first question to Dr. Nandalal Veerasinghe, now, which is actually related to Sri Lanka's economic performance. Now, in 2012, we observed that the government took key corrective policy measures, to name a few: upward revision of interest rates and upward revision of energy prices, import duties, imposing a credit ceiling, and of course devaluation of currency. Now, subsequent to that, we observed the economy of Sri Lanka slowing down, which was in fact growing above 7% for 9 consecutive quarters since 2010. Now, I'd like to ask, was this slowdown in economy anticipated?
Yeah. Ashani, first of all, let me thank the organizers for inviting me to this important session. When you look at the economic growth of Sri Lanka, especially the first 2 years after the end of the war, as you quite rightly mentioned, Ashani, that there was a significantly higher growth during, especially after 2009, because as we have seen, it was a huge opportunity, especially for domestic investors, domestic economic players. Those who have been earlier had been kind of restricted their activities because of the war or all the other issues that we had in the past. Then all of a sudden, this excitement came up, and everyone started to take their positions, increase their activities, and as a result, we saw a relatively higher growth, especially in the first 2 years after 2009. So 2010 and 2011, we saw 8% growth.
Yes.
So that was good. And what happened basically, the local investors and local entrepreneurs, they started to take the first advantage of the opportunity that came out after the end of the war. Then as a result of that, there were some imbalances growing in the other part of the economy. As you correctly said, overall macroeconomic balance or stability is much more important for long-term sustainable economic growth. So what we saw, until we allow this enthusiasm and opportunities to be taken up by local people first. So as a result, we had very good economic growth. At the same time, we saw the other imbalances, especially the trade and current account balance of the external accounts, balance of payments, were rising because people were starting to import a lot of things and started to invest a lot. As a result, there was partly on other side of the macroeconomic balance, there was a current account balance and trade balance was basically expanding.
Yes,
to a little bit more unsustainable levels. So
in 2011, we recorded a BOP negative by the end of 2011, yeah, almost USD 1 billion.
Yeah. And also current account deficit
yes,
went up to almost 7.5 8% of GDP in 2011. So, for us to have a sustainable long-term economic growth, the government and central bank, as we practically mentioned, brought in all these measures. The purpose of those measures is to prevent the economy overheating for a long period of time, and also to bring down some of the imbalances like current account deficit, trade deficit, to a more sustainable level. So once we bring in all these measures, obvious result actually as we expected was to slow down the economy a little bit. So what we saw after the introduction of those measures, we saw economy slowed down to around 6.4% by the end of 2012. And at the same time, the imbalances that were expanding on the other side also improved. For example, current account deficit from 7.8% came down to 6.6%, and it continues to coming down now. Trade balance, there was an improvement. So there's a balance between all those policy measures. There's a purpose. There is something that we would like to achieve. And in my view, we have achieved what we wanted to achieve in terms of slowing down the economy and bringing all the imbalances to a more balanced, sustainable level by end of 2012. Now we are in a lot more sustainable food now, so that we can achieve a sustainable, long-term, steady economic growth, rather than having 8% growth in 2 years and then coming down to 5-6% next year and again going up to 7-8%. Now we have a lot more benign macroeconomic conditions, so that we can go in the next few years on a sustainable basis 7-8% growth for next few years. What we believe is that basically this country has a capacity or potential to grow at least 7-8% going forward, because if you look at the amount of investment that have been taking place and the capacity or the new capacity that has come into the economic activities as a result of the end of the war, would obviously has increased the capacity to grow. So as a result, we have now lot more a very good base for us to project from here to next few years to achieve 7-8%. For that, obviously, we have to have right policies, at the right time. So we'll discuss about those later.
Okay. Now, correct me if I'm wrong. I mean, is it incorrect in assuming that the BOP deficit was mainly because of the boost in consumption, because of the policies, the key policy actions of relaxing policy actions that were taken into post-war? Is it only because of that?
Yeah, partly that was because of that. If you look at the numbers, why we had a large current account deficit, trade deficit, and also balance of payment deficit, and there was a small deficit in 2011. If you look at the sources of those deficits, mainly because the imports were growing at more than 50% in 2011. So major sources of those import growth were mainly the motor vehicle imports. All certain motor vehicles imports were increased by, I think, more than 100%, and the gold imports, and also a lot of consumption goods, because tourism was booming up, and there are other activities. So there's a large amount of new consumption items were coming in. I think that's, in a way, that was good, because this is an opportunity. People started to realize, okay, now we can have new cars, we can have, because we have the better roads in the network, so people did not have the opportunity. Government brought down the taxes, so people took the opportunity and then started to bring down this thing. Then, of course, that is one of the reasons. So that has supported the economic growth also to a certain extent. But that we can't have that kind of large consumption imports for a long period of time without having supportive other exports and other flows, so that you have balance in the balance of payment. So that is the reason why we government imposed certain restriction on increase duties in motor vehicles, increased taxes on gold, and then
rise in energy prices, hike in energy prices. Now, despite the policy measures that the government took in 2012 also affected investments, not only consumption. Isn't that correct?
Yeah, you see, when we take policy measures, actually the purpose of policy measures, like when we tighten the monetary policy, the major purpose or objective of the monetary policy, especially monetary tightening, is to bring down the aggregate demand. So when you want to bring down the aggregate demand, it has to be in both ways. it has to be slowing down consumption demand as well as slowing down investment demand.
Okay.
So that works both. It's very difficult for the government or the central bank to have a target. Okay, we will curtail only consumption part but not the investment part. So what the instrument that we have is the interest rates. So when we raise interest rates,
yes, it
basically
affects
then
both.
it will affect both. So that's why we saw a slow growth. That was not unexpected. That is the purpose of the tightening monetary policy. So that, but within the year we started relaxing the monetary policy, and we are in another part of the cycle.
Okay. Now, the government, as you correctly mentioned, is planning to boost the economic growth from 2013 onwards, and we see the government has set a target of economic growth of around 7.5%. But in 2013 quarter one data, according to the latest data, in 2013, the first quarter had actually indicated deacceleration in growth. It recorded only 6% growth in GDP. And considering that secondary market interest rates still being high, as well as energy prices again being revised up, how does the government intend to achieve this economic growth target in 2013?
Yeah, there are a few ways. Basically, that's obviously, we saw it in advance. That is one of the reasons why we started to relax monetary policy back in December 2012. If you can remember, when you start relaxing the monetary policy at that time, a lot of people kind of raising doubts about whether it's too early for us to relax monetary policy, whether central bank was taking wrong measures. Now, when you look at the outcome of inflation and growth following the monetary policy relaxation, it's very obvious that what we did was right at that time. Even now, we saw, even though we started relaxing monetary policy, because it was after about 12 months, almost 10-12 months tightening, then when you reverse the cycle, it takes some time for people to turn around. For example, now if you look at the banks, they have been raising deposits at compared to very high rates, around sometimes 14%, 15% fixed deposits. Even though when we relax the monetary policy, they could not immediately bring down the lending rates, because they have already committed to 1 year or more than deposits for 14-15%. Then their cost of funding is higher.
We need to go for a short commercial break. We'll be right back. Welcome back. Now, before the break, we were discussing about how the government intends to achieve this year's economic growth target of 7.5%. Dr. Veerasinghe, perhaps you could further elaborate on this.
Yeah, and this is that's why we relaxed monetary policy last year in December, and also this year in May and again June. What we saw, when we relaxed the monetary policy, immediately short-term interest rates like call money rates, treasury bills and bond rates came down immediately, responded appropriately. But as a result of commercial banks offering very high deposit rates, they could not bring down their market lending rates to SMEs, to other local investors. It was still, until last month, it was almost average 16.5% compared to inflation of around 7%. So that's why we brought the SRR, Surgical Reserve Ratio, down by another 2 percentage points, so that banks that created banks a lot more space for them to bring down their expenses. So that's how, that's why we believe in the second half, and even the banks are now have indicated their willingness to bring down the interest rates for the market rates. As a result, second half there will be a lot more economic activities, investment consumption activities, by bringing down the real lending rates for the people, those who are doing business. That is where we think the the second half the growth will come back. That is why during first half we did not see the growth as we expected, the low economic growth that we saw. I think this is also justification of why we brought down this RR, and then this is why we expect economic growth to resume during the second half of this year.
Yes, I believe this is correct because commercial bank lending rates slightly slowed down in May. So as you are saying, the government intends to boost economic growth by slowing down interest rates further, and the government expects that the secondary market interest rates would eventually further decline, come down in the coming months.
Yeah.
So now moving back to, I would like to direct this question to Mr. Gunawardana. Now we are discussing about Sri Lanka's economy, and of course we mentioned, we were discussing why Sri Lanka's economy slowed down in 2012. Now was this slowdown only unique to Sri Lanka, or if you compare similar economies, how does Sri Lanka fare with other similar economies?
Okay, so let me answer this question this way. If you look at successive governments in the past, virtually all of them overpromised and underdelivered to the promises given to Sri Lankans, be it economic, political or social. My point here is this: there is nothing wrong in having ambitious targets, but what is critical for the government is to show to people that they are committed towards delivering those promises through transparent, predictable and accountable actions. This was something which we saw in the war against terrorism during 2000 to 2009, 2006 particularly with the new government coming in, with the new president coming in. That was something which the entire country saw. Particularly it was more transparent, it was more accountable and it was more predictable that there is going to be a war victory sooner than later. So if the government can be equally similarly be transparent, accountable and predictable in their economic policy making as well as implementation, I believe and also communicate to the public that the way they communicate should be credible, so that people get more confidence. And I believe certain things that some critics are saying are quite overblown. And of course there are genuine concerns, there are serious and genuine concerns in the Sri Lankan economy, like high public sector debt and over dependence on few export markets and products. But certain things like slowing down in GDP growth, unemployment rates may not be as serious as what people are trying to show. In fact, we are doing a lot better than most of the frontier market economies and emerging market economies are doing. Let's look at some of the, let's compare GDP growth with the peer economies. And now, as a specialized research firm and representing that firm as head of that organization, we have categorized the economies, the markets, into 4 developed markets or economies, tiger markets economies, emerging markets, and frontier markets. Sri Lanka being a developing country and coming out from a relatively uncertain environment, we are categorized under frontier markets. So, and in that category, there are countries like Argentina, Bangladesh, Pakistan, Kenya, Vietnam, Saudi Arabia, and Venezuela. So, let's look at GDP growth for the last 3 years. If you look at 2010, Sri Lanka had the highest economic growth rate among the countries, among the emerging market economies that we follow. In 2010, we had a growth rate of 8%. And in 2011, only Argentina could beat the GDP growth figure of Sri Lanka, which we had 8.2%, and Argentina had 8.9%. And in 2012, Ashani, only Saudi Arabia could exceed our growth rate of 6.4%, despite having a slowed down growth rate of 6. Saudi Arabia had 6.8%, so it was only Saudi Arabia which could exceed our growth. I'm comparing only 8 frontier market economies. And not only that, Rashani, Sri Lanka has maintained a relatively higher growth rate compared to its peer economies, and and also our growth rate has been consistent than the peer economies. And if you take both, it's not just annually, even the quarterly results, we have been more consistent compared to most of the peer economies. Be it emerging market economies like India, China, Philippines, Indonesia, and frontier market economies that we just mentioned, Kenya, Bangladesh, Pakistan, so on and so forth. And let's take even unemployment. Sri Lanka again has one of the lowest unemployment rates when compared to frontier market economies as well as emerging market economies. And now let's look at the export performance of Sri Lanka. Of course, Sri Lanka's export export was coming down during the quarter as well as last year. But my personal opinion is that, Ashani, having a slowed down export growth is good, in the sense what I'm trying to say is it is an eye opener. It sounds alarm bells for policymakers to ensure that that country tries to diversify their export markets and products sooner than later, because the depending heavily on too few export markets and heavily on few export products is quite risky. And when there is a slowdown in those economies where we are depending on those markets, definitely the hit to Sri Lankan economies sometimes could be unbearable. But so far it has not happened that way. We have been able to manage that negative impact. And on the other hand, Ashani, the most recent discussion, most recent point that people were talking, especially last week, was this Moody's change of credit outlook to stable from positive. I mean, this is something, of course, as the head of independent investment research, pioneering independent investment research firm in Sri Lanka, that is something, of course, concerns me also, being independent organization, because only among those frontier market economies that we discussed, only Pakistan, Argentina and Venezuela has credit ratings below Sri Lanka. Okay. So rest of the other countries have either same or higher rating. I mean, even emerging frontier market economies. Of course, emerging market economies, if you take, all of them have investment grades, whereas all countries, all frontier market economies we follow, they all have speculative grade investment. So,
however, Sri Lanka does not have an investment grade grading. So
that's right.
We never had. So is there a possibility that we can or we can also obtain an investment grading for Sri Lanka?
Yeah, obviously, that's the plan. If you can remember, about 2 years ago, the headed by the central bank, we appointed a very high level committee, including the members of the private sector, to have a plan to target for our country to get the investment grade by, I think target was to come to investment grade by 2016. So there are certain things that we have to do. Basically, one of the reasons why Sri Lanka is still in the speculative grade, not in the investment grade, is our debt to GDP is relatively higher than the peer countries, those who are in the investment grade, except exception is India, because they have a large amount of resources. But that is where the government has strongly committed to bring down the debt to GDP from current levels of 80% of GDP to below 65% by 2016. So that is, as far as I can see, major impediments why the rating agency cannot upgrade us to investment grade is our fiscal position or government debt position. But that is, there's a strong commitment. But talking about the Moody's rating action, short-term rating actions.
We will be discussing that after a short commercial break. Welcome back. Now, before the break, we were discussing about one of the contemporary concerns, that is the recent Moody's downgrade in credit rating outlook from positive to stable. And of course, Dr. Veerasinghe was explaining to us about this. Doctor, perhaps you can elaborate on this further?
As a person who has been involved in very much in this rating process and also been in consulting process with rating agencies, what I can say, the Moody's upgraded us in somewhere back in I think 2011 to the positive outlook, and then they came back here in 2012. Look at all the situation, they still maintained the stable outlook. Then they came back again in 2013, and now they say, now in last week they said they are going to revise it downward for certain reasons. But that is why we do not understand the rationale for this. There is some inconsistency in their rationale, because if you compare 2012 June and 2013 June, there is a clear improvement in all the areas that they have raised concerns back in 2012 June. Especially, particularly we take very serious, I mean we look at very seriously the concern they raise, because we have a target of going to the investment grading in certain within next few years. So, we have addressed all these concerns and we have improved upon, if you compare 2012 June situation to now. So, that is why it is difficult for us to understand if they did not revise the ratings downward in 2012 June, we do not see any reason for them to revise it downward now, because if you compare that situation to now, we have improved as a lot, and also we compare to our peers, as Chamikara Quattrall pointed out, we also are above most of the peers. So, which means there is something we do not understand. That is why we issued a press release. I have no time to explain everything, but we have clearly put out a press release explaining how the rating decision has been inconsistent with their own policies and with their own rationale for revising ratings.
Well, I believe our viewers are very much clear on this recent issue of the downgrading of our credit rating outlook by Moody's. Now, earlier, of course, we were discussing about interest rates, and of course, Dr. Veerasinghe pointed out that the government and of course the Central Bank of Sri Lanka is attempting to bring down these interest rates. Now, I also know that the government intends to achieve mid-single digit inflationary target in 2013. And by bringing down interest rates, of course, there is a possibility to boost consumption, which can also have an inflationary pressure in the country. And right now, if we look at our average annual inflation stands at around 8.6%. So, how does the government intend to maintain inflationary target as well as boost the economic growth by bringing down interest rates?
Yeah, if I may make a little correction in our targets, as we have announced in our roadmap as well, our inflation target, bringing it down to mid to single digit, is not by end of this year, because we are coming from a 9% inflation from last year. So, bring it down to a 5% or mid single digit, it needs to take a certain longer period. So, that's why by end of this year our inflation target is 7%. So, next year it would be 6% and following year 5%, then longer term target would be 5%. So, that is how we plan our monetary policy. So, when we target 7% inflation by the end of the year, I am talking about the point to point inflation, because forward looking inflation, average is a historical one. So, forward looking inflation is what is the latest expectation of next 12 months. So, if you compare the inflation 7% target and if you look at the interest rates, the key fundamental behind the monetary policy or the monetary theory and monetary policy fundamental is that you need to maintain a certain amount of balanced real positive interest rate. Real positive interest rate means you look at future inflation and you look at the current interest rates. So, future inflation what we target is 7% by end of this year. Now, even policy rates is 9%. So, there is a clear 2% real interest rate gap. That is the incentive, and that is the balance between the savers and the consumption and investment. So, there is an incentive for savers there, because there is a real positive interest rate. At the same time, the lending rates will have to be come down little bit more, because real lending rate is still too high. If you compare the inflation 7% and real lending 16%, means the gap is almost 8%. If you compare the regional countries, a lot of other countries in similar situation, the difference between the inflation and the real lending rates is about 5% maximum. So, we are still, what we believe, we have a lot of space, the commercial banks have a lot of space to bring down the interest rates further without creating excessive demand that will create future inflation. So, that is why that is the right balance between the inflation and growth and interest rates.
Right. Now, we were talking about, of course, economic growth, and currently our investment to GDP ratio is around 30%. And of course, for one to achieve, I mean, there's a belief that for one to achieve a consistent level of economic growth, at least around 8%, you need to maintain this ratio to at least 35%. So, how does the government intend to boost investments and, of course, increase this ratio?
That's also an important question. I mean, the one correction here is not a correction; it's a view. Is that historically, if you look at basically in the past, for any country to reach at about say 8% growth, you may need to have 35% investment GDP growth. But what you see now, the new investments are more technologically, driven investments, that you don't need that amount of investments to achieve additional 1% of growth. Basically, if you look at our experience in last few years, last year we had investment GDP of 30%. Then as a result, we had about almost 7.5% growth on average, basically, which means now new investments are coming with a lot more productivity technology, which does not require that kind of a large physical investments for any country to grow at 7%. That's one point. So, that is why in our medium term framework, what we target is from current 30% to 32.5, 33% investment GDP in next 2 years. So, what the government can do, the next question is, there are two things. The role of the government here, if you look at total investment 30% of GDP, government is trying to maintain at least 5 to 6% of GDP by government investment. So, government has a capacity, the restriction. So, for government to maintain large amount of public investment, then government will have to collect a lot more taxes. So, then it would affect the investment on the other side. So, basically government role is one is to maintain at least 5 to 6%, which is historically higher than in the past. That is one thing. Other part is the government needs to encourage, or that is what government is also doing, to provide basic social and capital physical infrastructure and improve the doing business environment. So, that as I said, balance part will have to come from the private sector. So, what are the incentives for the private sector to come and invest? They have to have proper legal system, they have to have easier to do in business, they need to have basic public infrastructure, the roads, ports and everything. So, that is the government responsibility. So, while the government is facilitating to promote private investments and giving them opportunities, and also maintaining certain level of public investment, so that then the private also maintaining a certain balanced real interest rates. So, that private sector will have to come in and take these opportunities and fill that gap of balance almost 30% of GDP, or at least 25, 28, 29% GDP that has come from the private sector. So, government cannot, I must mention this, it is not the government's responsibility to maintain that kind of government responsibility is to facilitate or promote the private sector to come in and invest and then create employment.
Right. That's all we have for today, and I believe that this program has been able to address many of the contemporary concerns of our viewers regarding the macroeconomic situation in Sri Lanka. I would like to extend my special thanks to Dr. Nandalal Veerasinghe, Deputy Governor of Central Bank of Sri Lanka, for spending his valuable time with us today, and of course educating us on many areas regarding the Sri Lanka's macroeconomy. I would also like to thank our key resource personnel, Mr. Shamikra Gunawardena, founder of Investai Private Limited, for participating in today's program and sharing his thoughts on the discussion. We'll meet again in a fortnight on Sunday at 9:30 p.m. Good night.